our next article.
Yeah, rounding us out today, guys, we have the mortgage refinance demand jumping to a 2-year high as interest rates drop. Hey, what a perfect segue from our last conversation. What do you know? There must be a nerd around here somewhere. Applications to refinance a home loan jumped to 15% last week compared to the previous week, and the average contract interest rate for a 30-year fixed-rate mortgage with conforming loan balance decreased to 6.87% from 7%.
I have a really good example for that one.
Yeah, so I want to talk about that. But before we jump into that, I have a question for you guys. So here's the last point. Applications for a mortgage to purchase a home fell 3% for the week and are 14% lower than the same week 1 year ago. Here's my question. Is this an inventory problem, an attitude problem, or both?
I think it's both.
Why?
I think it's both because, a client finds a house that they want, but then they struggle on the price. And I've seen it sometimes where we like the house, but it's just too expensive. Yeah. And then, there's no other option. So then you either have to, make the decision, or you're just going to have to continue to wait until you find something that, is enticing for you to want to buy at the price point that, they're selling it for. And I think it's a two-road type of thing because, you're also looking at it as your primary residence. It's an emotional decision. But if there's not enough inventory, then that also plays into your emotions because you can't find what you like.
Okay. Yeah. So what would you say? Inventory, attitude, or both?
I'm going to say both. I mean, inventory is still the thing. And so it's, Brian just brought out a point earlier when we started. There's a home that's 1.8 and now they're offering 2.1.
Right.
It gets discouraging.
It's getting away from you.
And that's because of the lack of inventory too in certain areas. Yeah. So again, I'm talking about here, right?
Yeah.
If we're talking nationwide, I'm still going to say it's both because we're all having shortage issues.
Yeah.
And I think, why did they fall? I think it's because people are starting to realize, rates are going to start going down.
Yeah.
Inflation's better, unemployment's higher, and so therefore, it becomes their attitude, they're paying attention to these things that are in the media and stuff about the, unemployment rate increasing. People get worried, right? So it becomes now like, hey, I'll pump the brakes on that and see where the rates go, and let me just kind of wait it out for a little bit.
And, I'll say this, again, off camera in our private life, our personal life, we have some friends who are very highly qualified in their field and their trade, and they're 15, 20, 25-year veterans in what they have done professionally, and they cannot find work. But part of that is their seniority, and part of that is just the lack of availability of that said job at a different company. So I know that that's happening. In general, I think the squeeze is on. I mean, it's the squeeze on inventory. You got the squeeze on debt ratios when it comes to qualifying. You got the squeeze on rates. You got the squeeze because people are spending they're using their credit cards to spend for everyday needs. You got the squeeze everywhere.
Totally. Especially here in California.
Yeah, absolutely. And in every other, let's say, high cost metro that's listed on the top 100, it's Houston, Miami, other states that have their biggest city, they're having the same problem too. Now, I'm not going to sit here and claim that, we aren't better off than most people. We certainly are. I understand that. Like, you guys have a studio and you have lights and you're obviously using nice cameras. I get that. Don't hate. The point is that, look, everyone's feeling some level of squeeze right now. And even though mortgage refinancing has jumped, it's what we talked about in the previous segment. It's mostly solving a problem. Refinancing is to solve a problem. It's not because the rate is better. It's because there's something else that's more threatening than the refinance itself. So the refinance is a solution. And even though rates haven't completely plummeted and come down into, let's say, really favorable territory, they've come down enough for people to go, okay, maybe I'm going to have to do this in order to fix this other problem in my life and free up cash flow from out of pocket. It is just where we're at.
The great thing about all of this, Andy, it's mathematics. It's not going to lie to you.
Right.
If you're going to if it pencils out and it's telling you, and then you're putting in a different perspective as to, how do we utilize this cash that you're taking out, not to go buy a new vehicle, not to do a certain thing. Now, if you have the financing, you're able to do, okay. But why would you pay 11% or anything like that, on something so high when you can just go, I just said one of my friends got a Tesla at 0%. Chris, right?
Oh, yeah. At
0%.
Because they had it, they ran a deal on the Model Y.
Right.
And then they ran another deal on the Model 3, I think, right after that.
So
for
at
0.9% for the Model 3 or something like that. I'm like, what?
Which is crazy. He said he's going to pay about a little over $1,000 in interest.
Yeah. Isn't that
in
crazy?
the 5 years. That's nuts. So, I mean, I really think it's how you're leveraging your situation. Again, the math doesn't lie. Like he did the HELOC with the mortgage payment, and I know there's a blended rate. If you got 11 or 12%, and then you got a 3.5,
right,
you got your blended rate.
Yeah.
But sometimes even just taking it out, making all that interest, the bigger picture, a lot of times is just done.
So I think that this is like, it's a good sign for the mortgage industry, but it's not because of a good reason. It's like, this is working in the right direction. It looks like it's getting healthier in this segment of the industry. Well, yeah, kind of, but you got to look at the reason. It's not always just like, sunshine and rainbows. It's because people are having a real bad day financially, and this is their way out of it.
I mean, right now we're running a special on all VA IRRRLs and FHAs.
Yeah.
And we actually were seeing a 5.625 at no cost to the client. That's in conforming loans. It's pretty crazy to start hearing that, right?
Yeah, mid fives.
Yeah, it's like we haven't seen that
when's the last time you said when's the last time mid fives came out of your mouth? Like 2022. 2022.
Yeah, 2022 towards the end.
2 years ago.
When I locked in that purchase that I'm not refinancing.
Yeah. The last time I did your loan.
Yeah, exactly.
Oh my God.
But yeah, we're starting to see that, inflation starting. I know the Fed wants it at 2%. We're starting to see it. I think this Friday we're going to see a little higher than anticipated, but
probably.
So here we go with the volatility of rates, but at least now, and then we're starting to see unemployment. Unfortunately, our government wants to see us unemployed. They don't want to see us spending our money because that's all due to inflation.
Yeah.
So
it's like a solution solution for demand destruction. But the problem is we're still soaking up demand by using our freaking credit cards.
Exactly.
So it's not really destructing anything yet.
No.
One of the things I appreciate about our industry is that everybody's so positive when it comes to talking about the rates. You'll see like 7% down to 6.87. So I penciled the math out, right? So if you do a 766 500 purchase with 5% down, going conventional loan, $100 in insurance, $798 for property taxes, and $127 for your mortgage insurance, you get a payment of $5,870 with 81 cents. But hold on, rates came down last week, so that same scenario at 6.87 gives you a payment of $5,870 and 40 cents. A saving of 41 cents.
Hey, that's almost $50.
Let's get in the market. It's hot.
That's almost $50. Wow, that's amazing.
That's a great one.
Yeah. So it's always interesting how you can like spin. Like any news is good news, even if it's just by the
I've been cooked in my comments in my stories on Instagram because I'll post like rates are down, and then it's my buddy, from 7 to 6.99, you dick.
Yeah, they're like that's like my plane is making its final descent. We're not at 30,000 feet. We're at 28,000.
And I just gotta be honest, hey bro, I have to sell, bro. It's my job.
No, I mean the good thing is, not everything's a sell, right? I mean, the facts are the facts. Yeah, last week, I mean, like you said, we locked in a few clients. They went from a 6.75 down to a 5.625. That was a huge difference. That's huge. Like $400 some right there.
Shit, I'll take it.
On the loan amount, that's a big deal.
Yeah, I mean, it's an IRRRL, no out of pocket. Like, dude,
because at
that's
that point,
why I believe that this has increased because we've been seeing an uptick on it.
Yes, because at that point, now the person who's in that situation has to wager. Why wouldn't I do that? I'm not gonna. I'm saying no to saving $400 a month or $500 a month
because I want to save $800 to $1,000. Like, come on now.
Imagine this. Be a viewer and imagine your financial situation where you'd be able to go, I don't need to save $400 a month.
Yeah.
That must be a nice situation, isn't it?
Very nice situation.
If you're not in that situation, guess what? People are saving $400 a month or $500 a month because they're using the IRRRL and the FHA Streamline. Yeah. So I think this is a solution. I think it's going to be more of this. I think you get June's data in July when all the June data comes in, all the July data is concluded. I think you roll into the fall, you're going to see that summertime we're actually kind of pivoting and kind of coming over this hump on the horizon of refinancing coming back because people need to, not because it's just a nice rate.
Winter is coming.
Winter. It's coming. All right.
Did you have another point on that, Brian, or you just want to say winter's coming?
Winter's coming, and then we laughed, and then I kind of lost.
You lost the train of thought. Memo. No more new thoughts from Brian today.
Nope.